Friends, in this video for I Thought Wealth, I am going to talk to you on the topic achieving scale. Everybody who comes into equity investing craves to achieve scale. When you see other investors hold 1% in a company and their name appear in the list of shareholders, it's very natural that you think that one day it should happen to you as well. While these larger, bigger, king size ambitions are all good, it's very important to know where you begin and what you should do first so that you don't become a victim and leave the stock market before it's your time to win in it. Why do I say this? Because in my experience, I have seen that people who come into stock market with a lot of ambition, high energy and strong conviction tend to overplay their hand and leave the markets too early. There are many friends of mine whom I have seen in the early days of investing who left the market within 3-4 years. And these are very bright people. They are very educated as well. And these are people who read a lot, and yet they could not show longevity in the stock market. So, showing longevity in the stock market should be a very, very important criteria, should be your primary objective. And how can you do this first? The first thing an investor must decide for himself is where he wants to invest. I feel an investor should initially invest in a much safer investment zone. By doing that, you ensure that you avoid bad accidents, you make investment decisions in a zone of comfort, governance never becomes a villain to your investing, and you are able to freely add whatever savings you can add into your investments without high anxiety. By safe zoning your portfolio, you can ensure that you are going to invest in a kind of a safety bubble. But this doesn't appeal to most investors. Most people want to play outside what is their safe zone. They want to take risks which they cannot control purely for one reason. They think that taking those risks is going to give them higher returns. But my experience is to the contrary. Investors who played outside the safe zone always got sucked into the deep end and got drowned in bad decisions. So, playing in the safe zone, swimming in a zone of comfort is the first secret to longevity in the markets. Investors who invest in decent companies which offer stable growth by buying them at valuations which are in their favor have ensured they stay long years in the stock market. When I look at my first investment cycle, I feel I was lucky that I did not venture outside a certain zone of comfort. Because I did not venture outside that zone of comfort, I was lucky to survive the first crash. I didn't have companies which lost very high percentage of the market value after the crash. And I also owned companies which were the first to rebound when market stabilized. The reason is that these choices were clearly in what I call as the safe zone of investing. So, making investment choices in the safe zone is the first secret to your longevity in the stock market. Many people say, how do I know? How much can I read? How can I avoid buying outside the safe zone? If you can't do that, I think that buying a very stable large cap fund would be a very strong way to stay safe. But most of you don't think it's very attractive to do that. But I still think that buying a large cap fund and continuously buying into it is one of the simplest and safest ways to staying in the market without losing your confidence and without losing money. Many people want to also participate in the faster growing parts of the market. It could be mid cap, it could be small cap, it could be some theme, some industry specific idea. If you are that kind who want to do that, again add layers to your large cap fund by adding a few funds. I believe that the first 10 lakhs of your investments, the road to 1 million rupees is best journeyed through mutual funds. And after going there, you can take stock whether you're mentally ready to do anything beyond that. Because the next milestone should be 25 lakhs, 2.5 million. Going to 2.5 million is again a longer journey because you need to invest more money for extended periods of time under different circumstances. So invest regularly in a basket of mutual funds once you cross 10 lakhs and build that basket consistently either through an SIP with a step up, and also try and add some lump sums whenever markets are very much in your favor. So by doing these two things, you can go to the next milestone. Till an investor reaches 50 lakhs of financial assets, I believe that mutual funds is a very, very safe zone for him to play and for him to show his temperament in staying the course with his investments. Once you reach 50 lakhs, then you can gradually keep adding your incremental investments directly into equity and then gradually decide which suits you more. Choosing a vehicle, deciding on a medium ensures that your journey towards milestones happens very harmoniously. The management of your investments is done by a fund manager while you only manage your behavior, your liquidity and opportunity. That makes your job much simpler. Keeping it simple is the super secret of staying the course with investments. When you keep it simple, you also give yourself the opportunity to add layers as your corpus grows. Your risk appetite will also grow over time as you get accustomed to what is good for you and what suits you. So you also have the luxury of adding some layers. You can bring in a theme, you can add some small caps, you can do some mid cap, you can buy some global products, and you can gradually build a portfolio which does different things. There are many people who think that, oh, mutual funds, they're so boring. But there are a number of products which gives much broader geographical reach. I'll give you an example. We were able to spot an opportunity in a mining fund when mining stocks were going down just a few months ago. And once the Russia crisis happened, this mining fund in which we had bought a reasonable position size in portfolios gave 60% returns, right? This is something which you can always find in mutual funds, and you can add such a product as a layer to your portfolio. So while your large cap and your flexi cap does the job of creating the base returns, you can add some other products to the extent of 5 to 10% in your portfolio, which will give you the higher return and take your overall return onto a higher plane. So these are things which funds give you as opportunities which you can do comfortably without putting your overall portfolio to risk. On the contrary, I've seen a number of stock portfolios of people who are first timers in the market. They have built portfolios without understanding the principles of portfolio construction. The portfolios are distinctly imbalanced. Choices are made impulsively. The winners have gone out and the losers are still sitting there. He doesn't know what to do with the losers and he's still hoping that some miracle will make the loser into a winner again. These are things which generally cut short investment journeys of people in the stock market. And I think that it's very important that you don't create a situation where you lose confidence in your own ability to stay the course, to reach milestones and go beyond that. That in essence is what every investor must ensure. So think for yourself, see what suits you, take a safer course, layer your investments nicely, build a nice balanced equity portfolio and grow it with every market opportunity. Thank you for watching this video.